Welcome to the deep dive, where we take that chaotic fire hose of information you see every day, all the articles, the research, the market noise, and really just distill it down.
Yeah, we try to find the essential, the surprising, and, the most actionable knowledge you need right now.
And today's sources, they paint a picture of just, well, extreme cognitive dissonance.
They really do. I mean, if you're trying to figure out the state of the crypto industry today, you are looking at what feels like a bull and a bear market happening at the exact same time.
Okay, so what do you mean by that?
Well, we're seeing deep institutional pain on one side, but then spectacular institutional growth in some really unexpected altcoins on the other.
And then there's this third track.
And then there's this completely revolutionary application where the philosophy of blockchain is having an impact, far, far away from any trading screen.
That contradiction, that's our mission today. We're going to analyze these three wildly contrasting narratives, the market struggles, the institutional milestones, and these surprising real-world applications to really get a handle on the state of industry growth.
Right. And to do that, we have to start with a quick snapshot, just to set the scene. This is data from December 16th.
Okay.
As of Monday, the global crypto market cap is holding pretty firm above that symbolic $3 trillion mark. It's at $3.01 trillion.
That 3 trillion figure, that's an important anchor, right? It puts us well beyond the speculative peaks of past cycles.
Exactly. But if you look closer, Bitcoin is trading around, say, $86,000. Dominance is at 59.1%.
And Ethereum,
ETH is near 2,900, and Solana is sitting around 125. But that high-level stability, it gives you this false sense of calm.
because underneath.
Because once we start digging into the sources on institutional money, we find some significant turbulence.
Okay, let's unpack that. Let's just jump straight into the pain point
Right.
because those high-level numbers, they really mask a market reality check. Some sources are suggesting this is the toughest environment for long-term holders since, what, the big bear market of 2022?
It is a massive reality check, especially for everyone who celebrated the launch of the Bitcoin spot ETFs as, the final step toward market stability.
Right.
We have data from the analysis firm Check on Chain, and the figures really quantify the psychological pressure the market is under right now.
So what's the headline number, the one that kind of defines the overall mood?
Across the entire digital asset market, our sources estimate there's about $100 billion in unrealized losses right now.
Wow,
Yeah, that's capital that's been deployed and is currently underwater on paper.
$100 billion in unrealized loss. I mean, that's a powerful figure. But let's narrow it down to the big one, the BTC ETF. What's the specific takeaway there?
This is the data point that should genuinely grab your attention. About 60% of the capital that flowed into Bitcoin spot ETFs is currently in an unrealized loss state.
60%. So you're saying 6 out of every $10 that went into this new institutional gateway
The regulated, easy access product everyone was waiting for.
is currently sitting below its purchase price. If you bought the hype, you are feeling the burn.
Absolutely. And it completely undermines that initial story, right? The idea that institutional involvement automatically equals immediate price stability or, guaranteed profits.
Right.
Investors came in on this long-term conviction, but the short-term reality is they bought into a volatile market and they bought in near the highs.
So this is the aha moment for you.
This is the crucial one. The institutional gateway, it only grants you access to the market's volatility. It doesn't guarantee stability.
So if 60% of this new institutional money is underwater, doesn't that risk permanent damage to the narrative? I mean, the idea that these ETFs bring maturity to the market, is this just institutional retail money that gets spooked easily?
That is the critical question, the selling pressure we're seeing. It's coming from those investors who, chased that initial launch excitement and are now capitulating.
And we saw the result of that on Monday.
We did. The immediate consequence was on Monday, December 16th. BTC spot ETFs recorded a huge $350 million net outflow.
Which was the largest in a month, right?
The largest single day outflow in about a month, yeah. It directly reflects that pain and that capitulation.
It's the classic buy the rumors, sell the news thing, but it's playing out with giant institutional players this time, not just small retail. So it definitely dampens the euphoria around BTC,
It does, but this is where the narrative just completely flips on its head.
demonstrating that split market we talked about.
Exactly. We go instantly from the BTC pain point right into this altcoin institutional paradox. The money leaving Bitcoin, it seems to be flowing right into products for these smaller names.
So let's look at those milestones. The sources highlight some incredible inflows for XRP and Solana ETFs. It really suggests the demand for diversified digital assets is just spiking.
That's right. For XRP, institutional products hit a pretty significant milestone. $1 billion in cumulative inflows
In just 1 month.
in just 1 month. Since trading started on November 13th, we're talking funds like Canary, Grayscale, and Franklin Templeton all involved. It's a huge threshold for an altcoin product.
And Solana, which is the other big name here, it's not far behind in showing this institutional appetite.
Not at all. Solana spot ETFs, they launched back in October, and they've already accumulated $710 million in cumulative net inflows.
So you combine those two.
You combine them, and you see the significant pool of new capital flowing outside of that dominant Bitcoin and Ethereum world.
Our sources quoted Vincent Liu, the CIO of Kronos Research, and he noted that this just shows a growing institutional demand for regulated exposure to assets beyond just Bitcoin and Ethereum.
Right, institutions aren't just dipping a toe in anymore. They are actively looking for diversified exposure.
Which is a sign of maturation.
A very rapid maturation, but we have to address the extreme friction around one of these assets, XRP. We have the billion-dollar institutional success story happening at the same time as just dramatic technical turbulence for the asset itself.
Okay, so what is the market signaling? What happened when the price of XRP broke that key $2 level?
What's so fascinating is this massive disconnect. You have this huge institutional belief, right, the ETF inflows,
Right.
and then you have the short-term emotional trading. And when XRP broke that crucial $2 support level, it was a severe psychological breaking point. It led to an acceleration of selling pressure.
How do the charts look? I mean, are we seeing a deep collapse or is this just a correction?
The charts are signaling very strong bearish momentum. Our sources described it as a panic psychological state among traders.
Yeah.
The trend lines are sharply down, and the gap between them is widening, which indicates that negative pressure is accelerating.
So traders are just throwing in the towel.
Basically. Yeah.
So where does it find a floor now that the
Oh.
$2 support, which felt rock solid, is gone?
Well, the immediate technical focus is on that double bottom area. It was established during that sharp drop in late November.
Which is where?
It's sitting between $1.80 and $1.85. If the selling pressure pushes past that level, the risk of a much deeper decline becomes very, very real.
So for XRP to recover, it's an uphill climb.
A huge uphill climb. That previous support zone of, say, $1.95 to $2, that now acts as a very powerful resistance barrier. So a fast, V-shaped recovery is going to be exceptionally difficult.
So you've got technical fear battling institutional hope. But XRP is trying to strengthen its utility to back up that interest, right?
Mm-hmm.
You saw the launch of Wrapped XRP.
That's Ripple's big strategic move. They're trying to break out of the constraints of their native chain and
Yeah.
appeal to the broader DeFi world.
Right.
They launched wXRP, and the whole goal is to expand its activity across major chains like Ethereum and, importantly, Solana.
Which makes sense. If institutional money is pouring into Solana ETFs, Ripple wants to make sure its asset can play in the Solana ecosystem.
Precisely. Hex Trust launched wXRP on December 12th. They started with $100 million in initial liquidity.
And the idea is to use it in trading pairs with Ripple stablecoin.
Yeah, with RLUSD. It is an explicit bid for deeper utility and integration into the whole system.
But the sources flagged a note of caution here about this rapid expansion.
They did. I mean, anytime you rapidly bridge an asset across multiple chains, you're significantly increasing the system's complexity.
Yeah.
Its surface area for attack.
Right.
The sources explicitly mention security concerns associated with this kind of rapid, high-value expansion, which is it's a necessary caution when you're dealing with these interoperability solutions.
Absolutely. And that friction, that institutional belief fighting market fear, it perfectly sets the stage for our third narrative. Because the most compelling growth, the kind that shows the true disruptive potential, well, it isn't happening on a trading screen at all. And here's where it gets really interesting. We are talking about applying blockchain thought to Japanese agriculture, of all things.
Courtesy of Jack Ma.
Of Jack Ma.
It's the most unconventional story in the source material, but it really highlights the pure philosophy of decentralization being applied to real-world efficiency and logistics. It's about organizational structure, not token economics.
So Alibaba founder Jack Ma, he's apparently shifted his focus to Japanese small-scale agriculture. He's engaging with researchers and farmers at the University of Tokyo. I mean, why is a tech billionaire interested in tiny Japanese farms?
Because he highly values what he calls their decentralized nature. He sees a direct philosophical parallel between the efficiency of these small-scale, locally focused distributed farms and the core concept of blockchain thought.
So wait, it's not that he's putting rice on a blockchain.
Not at all.
He's praising the distributed power structure, the local autonomy, and how efficient they are with resources.
Exactly. He's specifically praising their ability to get high fertilizer utilization efficiency with very limited land. This distributed model, where power and decision-making are dispersed and locally optimized, that is the philosophical equivalent of a blockchain.
A resilient, efficient, distributed system.
It is. It's fantastic to see that conceptual transfer happening outside of finance.
It really shows that blockchain is maturing. It's moving from just being a technology for digital cash into an organizational blueprint.
Hmm.
And speaking of blueprints, the traditional finance world is quietly adopting the infrastructure side of Web3 at the exact same moment.
This is where the Jack Ma story and the Wall Street story just collide. It shows two really distinct paths to adoption. We have two massive data points here from the traditional finance giants.
Okay, give us the updates from the finance world.
First up, Visa. They announced they've started using the Solana blockchain for institutional settlements of US dollar stablecoin, USDC,
In the US.
from the United States, yeah. They explicitly named Solana as the fast chain that the initial banks are using for these high-value transfers.
That is a colossal vote of confidence in Solana's speed and reliability. It means they see Solana not as some speculative asset platform, but as a critical piece of modern global payment rails.
It absolutely validates the underlying tech. And then you have PayPal, which is wading even deeper into the stablecoin game, but from the consumer side.
They launched their PYUSD product. What's the news there?
PayPal launched a PYUSD savings product. It's in partnership with a company called Spark, and they are offering a significant annual percentage yield of 4.25%.
Which is much higher than most traditional savings accounts today.
Much higher. And they've set a really aggressive goal of hitting $1 billion in deposits for this new product. They clearly see digital dollars as a key consumer offering.
And this mainstream adoption, Visa using Solana on the back end, PayPal using stablecoins for consumer yield, this is all happening just as regulatory clarity is finally starting to emerge.
That is the crucial context that ties this all together.
Right.
The sources noted that in Washington, the FDIC recently clarified rules under something called the Genius Act, and it's basically laying the groundwork for banks to issue and hold stablecoins. It signals that regulators are accepting these assets as a formal part of the banking infrastructure.
So what does this all mean when you put it together? The philosophical idea from Jack Ma's farming parallel, next to the fact that Visa and PayPal are building their future on regulated digital dollars and fast chains.
It means blockchain is fundamentally maturing beyond just speculative trading. In one camp, with Ma, you have the decentralized philosophy being used to analyze efficiency in agriculture.
Okay.
In the other camp, with Visa and PayPal, the technology itself is becoming critical infrastructure for regulated finance. We are witnessing the integration of digital dollars and high-speed chains into the financial rails we already use. It's moving the conversation from if these systems will be used to how they're being integrated into our everyday lives.
And that distinction, the philosophical ideal versus the infrastructure reality, that is the entire game changer for you to focus on.
It really is.
So let's just quickly recap the three opposing forces that define the market right now. First, the BTC ETF pain. 60% of capital is underwater, driving short-term outflows and, well, damaging that whole stability narrative.
Right. Then second, you have the altcoin ETF paradox. XRP and Solana are pulling in over $1.7 billion in institutional money, but the underlying XRP asset is facing a panic psychological state and a tough technical recovery.
And finally, the real-world utility. It's emerging through that philosophical application in places like Japanese farming, and that's running parallel to the concrete adoption by financial giants like Visa using Solana for USDC settlements.
And PayPal offering high yields on PYUSD savings, all of it backed by this ongoing regulatory formalization.
Which brings us to the final question.
It does, and it raises a really important question for you to consider. We see traditional finance adopting stablecoins and fast chains like Solana, especially as regulators debate, control, and formalize bank rules under things like the Genius Act. So, if stablecoins backed by banks are formalized, and tech giants like PayPal are offering 4.25% yields, does the future of financial stability and utility lie solely in these regulated digital dollars from the incumbents? Or does the core decentralized ethos, that distributed optimization that Jack Ma is seeing in farming, that applies to non-financial sectors from the ground up, does that remain the true long-term promise of the technology?
That's a profound distinction. Is the highest utility of this whole invention the regulated digital dollar provided by the big guys? Or is it the distributed model that changes how organizations themselves are structured?
Yep.
That's something for you to mull over as you process this deep dive. We'll see you next time.